Let's say you're about to buy a stock, and someone asks you, are you overpaying or getting a deal? Most people freeze because they have no idea. But what if I told you there's one simple number that can instantly tell you whether a stock is cheap, expensive, or somewhere in between? In this video, I'm going to break down the PE ratio in the simplest way possible. By the end, you'll know what it actually means, how to use it correctly, and why most people misunderstand it. No complicated finance talk, just clarity. Let's strip this down to basics. Every company makes money, and when you buy a stock, you're buying a piece of that profit. Now here's the real question. How much are you paying for that profit? That's exactly what the PE ratio tells you. It's simply price divided by earnings. In plain English, how much am I paying for every dollar this company earns? Let's make this real. Imagine a stock is priced at $100 and the company earns $10 per share. That gives you a PE ratio of 10. What does that mean? You're paying $10 for every $1 of profit. Another way to think about it, if nothing changes, it would take about 10 years to earn your money back. Now, suddenly, it makes sense. But here's where people get it wrong. They think low PE means good, high PE means bad. That's not always true. Let me show you why. A high PE ratio usually means one thing. Investors expect big growth. They're willing to pay more today because they believe earnings will grow fast in the future. This is common in tech companies, startups, and fast-growing industries. On the flip side, a low PE ratio could mean two things. The company is undervalued or it has problems. Slow growth, declining business, uncertainty. So PE isn't just about price, it's about expectations. Here's a mistake beginners make all the time, comparing companies from different industries. That doesn't work, because each industry has its own normal PE range. For example, a tech company might have a PE of 50, while a utility company might have a PE of 10. Does that mean tech is overpriced? No. Tech grows faster. Utilities are stable but slow. Always compare companies within the same industry. Now imagine two companies in the same industry. One has a PE of 10, the other has a PE of 15. At first glance, the second one looks expensive. But what if that company is launching new products, expanding globally, and growing faster? Now that higher PE might actually be justified. Now, there are two types you need to know. First, trailing PE. This is based on past earnings, real data, what already happened. Second, forward PE. This is based on future estimates, predictions, what might happen. Here's the key insight. If forward PE is lower than trailing PE, investors expect growth. If it's higher, they expect trouble ahead. But remember, predictions can be wrong. The PE ratio is powerful, but it's not perfect. It misses things like future potential, debt levels, cash flow, and short-term distortions. A company could look cheap but actually be declining, or look expensive but growing fast. That's why smart investors never rely on just one number. So here's the truth. The PE ratio doesn't tell you what to buy. It helps you understand what the market expects. And once you understand expectations, you start thinking like an investor. At the end of the day, investing isn't about finding cheap stocks. It's about finding value relative to the future. Because the biggest returns come from being right about what happens next. If this made the PE ratio finally click, hit that like button. Subscribe for simple, powerful investing content. And next, I'll show you the other key metrics smart investors use together with PE, because that's where the real edge is.